Welcome to the deep dive. Today we're digging into a really specific and kind of surprising set of documents. We're looking at a financial services company that seems to live in two worlds at once. You've got this super fast, high-risk global trading on one hand, and then commitment to, well, very slow, very long-term climate solutions on the other. It's quite the mix.
It really is. It's a study in contrast, you could say. The sources center on 3M Financial Services, founded by Mohammed Majid. We've got official papers showing, billions in trading activity, complex compliance stuff, and right next to that, certificates about funding these really advanced carbon removal projects. So the question becomes, what does modern global finance actually look like when you zoom out and see the whole picture, funding planetary tech?
Exactly. Okay, so before we hit those big numbers, let's establish the basics. The credentials. This isn't some pop-up shop. In Pakistan, 3M Financial Services, SMC Private Limited, is listed officially with the SECP, that's the Securities and Exchange Commission of Pakistan.
Right. And the founder, Mohammed Majid, he's registered with the FBR too. Federal Board of Revenue. That registration is quite recent, Feb 2024, just listed under business.
Okay, but that recent date is maybe a bit misleading.
Well, yeah, it only tells part of the story. If you look back further, there's a much longer history here. Multinational, even. We found registration docs for a company called Capital Marginal Multi-World, SDNBHD.
Okay.
In Malaysia. And that was incorporated way back in February 2010, over a decade ago.
SDNBHD.
Yeah.
Just so listeners know, that's basically the Malaysian version of a private limited company.
Right.
Incorporated under their law.
Exactly right. Established, regulated there. And Mohammed Majid, who's there from the start, chairman director on those docs, holding most of the shares to 450,000 out of 500,000 authorized shares.
Wow, so the vast majority ownership.
Each share at 1 Malaysian ringgit, but the point is the control, the leadership. It shows this isn't a brand new venture that just started in 2024. It's well established, it's got deep roots, a global footprint spanning continents and well over 10 years.
Okay, that sets the stage. So, established entity, long history. Now let's unpack this. The engine room, the trading operations. Because the scale here, revealed in these summaries, it's kind of staggering.
It really is. We're looking at an Xmas account summary, right? Covering just 1 year, 365 days. And the trading volume generated in that single year, get this, over $657.5 million USD.
$657 million. In 1 year.
Yeah. And that's not even the lifetime total for the account. The documents show the lifetime trading volume is over $1.8 billion USD.
Okay, 1.8 billion. That's institutional level activity almost.
Pretty much. And think about what it takes to generate that kind of turnover. The summary shows almost 25,000 closed orders. 24,929 to be precise.
Wow.
About 14,000 of those were profitable, over 10,000 were not. The net profit for that specific year was 128,367 USD. But the key thing isn't just the profit, it's the sheer volume, the frequency, cycling capital at that immense level.
And that kind of activity gets you noticed, right?
Absolutely. It puts them in the top tier. The account qualified for Exodus Premier Signature status. It's prestigious, and you don't get that just from volume. You need capital commitment too. Consistent deposits, the lifetime deposit value mentioned, the one that helped qualify them, 448,351 USD.
Almost $500,000 just in deposits over time. And the perks match the statics, I assume.
Oh yeah. The source mentions a specific promotion tied to hitting that Premier Signature level. A fully sponsored trip to Malaysia, all expenses paid. So the incentives definitely track the high volume nature of it all.
Okay, so huge volumes, elite status.
Yeah.
But how do they achieve that? What kind of trading are we talking about? Because the risk must be immense.
Exactly. And to understand that, we have to look at the methodology. The source gives us a glimpse. There's a snapshot of one trade. Highly speculative. It's a Binance futures trade, labeled short 50x TRB USDT perpetual. And it shows a gain of, wait for it, plus 1640.21%.
1,600% on one trade. Okay, hang on. 50x leverage. Can you break that down? What does 50x actually mean for someone not deep in trading?
Sure. Think of leverage like borrowing money to make your trade bigger, much bigger. With 50x leverage, for every $1 of your own money, you're controlling $50 worth of the asset. You borrowed the other $49 effectively. It massively magnifies everything.
So huge potential gains.
Like that 1,640%, yeah. If the market moves sharply in your direction, the returns can be astronomical. But it magnifies losses just as much.
Right.
If that trade had gone against them by just, say, 2%, they would have been wiped out, completely liquidated on that position. So this shows they're running a proprietary trading desk, their own money, operating at like the absolute maximum risk tolerance level.
Wow. That sounds incredibly intense, almost like gambling at that level. So
Yeah.
how do they square that extreme risk-taking with offering investments to clients? Seems like a conflict.
But that's where the strategy seems to come in, based on these sources. It's about separation. They contrast that super high-risk, high-leverage proprietary trading their own funds with what they offer the public. The client investment proposal is different. It's marketed for diversified commodities, things like gold, silver, oil, currencies. Stuff aimed at more traditional investors looking for steady growth, not, 1,600% overnight wins.
Right, so what kind of return are they offering clients then?
The key benefit highlighted for clients is much more stable. An average daily return between 0.5% to 0.8% on the capital invested.
Okay, 0.5 to 0.8% daily. That's still substantial, but worlds away from 1,600% on a single trade. A totally different risk profile.
Totally different. And the terms for clients reflect that stability focus too. Minimum investment period is 3 months. And if you want to pull your money out, you need to give 1 month's notice.
So controls in place.
Exactly. It suggests a model where the high-risk prop trading desks, and that $1.8 billion turnover machine you mentioned, that's the engine. It generates the high-octane capital for the business. But the client funds, they seem to be managed separately, likely using much more conservative, diversified strategies. The goal there is steady returns, insulating clients from that extreme volatility. We even see examples in the source material of profit-sharing payouts, specific amounts paid to clients in Pakistani rupees, PKR.
Interesting, so it's like a two-pronged approach. High risk internally generates capital. Lower risk externally provides client stability and documented payouts.
It looks like a deliberate strategy, marrying risk mitigation for clients with high growth capital generation internally.
Okay, so if we connect that high-speed trading and capital generation back to the bigger picture, doing that kind of volume across global markets, it must require some serious banking infrastructure, right?
Oh, absolutely. You can't move billions efficiently, settle trades across time zones if you're stuck with slow single currency banking. It just doesn't work at that scale. And the sources show exactly that. A really impressive and strategically vital portfolio of international bank accounts held by Mohammed Majid. This setup isn't just for show, it's fundamental to how they operate.
And it's quite distributed, isn't it? Not just one offshore account.
No, not at all. We're talking 5 accounts across 5 major global currency zones. Let me list them. There's a USD account in USA Citibank, Wall Street, New York.
Okay, the US dollar covered.
Then a GBP account for British pounds in the UK with Barclays. An AED account for UAE dirhams Standard Chartered in Dubai.
Middle East presence too.
Yep. A EOR account for the Eurozone Banking Circle SA in Luxembourg. And finally, an AUD account for Australian dollar Citibank again, but in Sydney.
Wow. USA, UK, UAE, Eurozone, Australia. That's pretty comprehensive global coverage. What's the strategic edge there? Why spread the liquidity like that?
It tackles several key operational challenges for a global trader. First, speed. If you're trading across exchanges worldwide, you need cash ready to settle instantly, regardless of the time zone. This allows that. Second, risk mitigation. Holding balances in multiple major stable reserve currencies reduces exposure to any single currency's fluctuations or, sovereign risk issues.
Makes sense.
And third, cost optimization. Imagine trading a huge Euro-USD position.
Yeah.
Having accounts in both euros and US dollars means you can settle directly in each jurisdiction. No need for costly conversions through an intermediary bank. It demonstrates a really sophisticated operational framework built for global financial fluidity.
So, putting it all together up to this point, we have a business that's highly regulated, registered in Pakistan, long history back to Malaysia, even UK visa documentation mentioned. But it's simultaneously executing these massive billion-dollar high-leverage trades instantly across, 5 international currency zones.
That's the picture painted by these documents, yes. The definition of a globally fluid, complex financial entity.
Okay, and here's where the story takes that really fascinating turn we mentioned at the start. Because the money generated from all this high-speed global finance, it isn't just going back into more trading. The sources show a specific chunk is dedicated to something completely different. Cutting-edge climate action.
Yeah, the shift is almost jarring, but it seems very deliberate, very strategic. The documents confirm 3M Financial Services contributes 2% of its total revenue, not profit, revenue, to carbon removal as the dedicated member of Strike Climate.
2% of revenue. That's quite significant. And the source highlights a key distinction here, too.
It does. It explicitly states that 3M Financial Services is the first Pakistani firm to publicly join forces with Stripe on this specific kind of next-generation carbon removal initiative.
A first for Pakistan in this program. And this isn't just planting trees or buying basic offsets, right? This Stripe climate thing is different.
Very different. It's not about just balancing the books with easily available credits. The stated logic here is about direct investment in future tech. It's about accelerating the cost curve. They seem to recognize that businesses like them, acting as early customers funded by these trading profits, can help make promising new carbon removal technologies cheaper and help them scale up much faster.
Okay, so why does being an early customer matter so much for these technologies?
Well, the source uses a really interesting analogy. It compares the potential of carbon removal tech to the cost journey of other major innovations. Think about solar panels, or hard drives, or even DNA sequencing.
Right, they were all incredibly expensive when they first came out.
Exactly, prohibitively so for most. But early adopters, early demand, helped drive down those manufacturing costs dramatically over time. The argument here is that permanent carbon removal tech is on a similar path. By stepping up now as a foundational customer, they're essentially helping to pay down the initial high costs. The goal is to make these powerful permanent solutions affordable and accessible for everyone down the line.
So the high-speed finance world is acting as patient, early-stage capital for tech that might take decades to fully mature and scale globally. That's quite a juxtaposition. What specific projects are they actually funding through Stripe Climate Debt? Do we know?
We do. The source material details 2 flagship examples of the emerging technologies they're supporting. Both are focused on permanent removal. First, there's a company called Climeworks.
Okay.
They use renewable energy for something called direct air capture, or DAC, basically giant machines that pull CO directly out of the ambient air around us. Then they concentrate the captured CO.
And what happens to it then? How's it stored permanently?
That's the crucial part. They partner with another company, CarbFix. CarbFix injects this concentrated KIO deep underground into specific types of basaltic rock formations. The KIO reacts chemically with the basalt and essentially mineralizes. It turns into a solid stone, permanently locked away.
Wow, turning CO2 into rock underground.
Yeah.
That definitely sounds permanent.
It's considered one of the most secure long-term storage methods. And this Climeworks CarbFix partnership, funded partly by Stripe Climate members like 3M Financial Services, has already removed 322 tons of co-arrows.
Okay, 322 tons via DAC mineralization. What's the second project mentioned? Charm Industrial.
Right, Charm Industrial. Equally innovative, but a different approach. They focus on biomass, they take agricultural waste stuff like leftover corn stalks, things that would normally decompose and release carbon anyway, and they convert it into a stable, carbon-rich bio-oil.
Bio-oil from farm waste, okay. Then what?
Then they inject that bio-oil deep underground into geologic storage formations. Similar idea to CO2 injection, but using the stabilized bio-oil. Again, the goal is permanent sequestration of that carbon, keeping it out of the atmosphere for millennia.
And Stripe Climate played a key role with Charm too.
A critical early role. The source notes Stripe Climate was Charm Industrial's very first customer.
Their first one.
Yeah. That initial commitment, that early capital injection, was apparently vital for Charm to scale up its operations, and it led to them removing 416 tons of co-euro back in 2021, specifically on behalf of the businesses in the Stripe Climate partnership. So you can really see the direct line. Revenue from high-risk, high-volume trading is being channeled into the seed stage of these potentially world-changing, permanent climate solutions.
That's quite a journey we've traced then. From SECP registrations in Malaysian corporate history, through billion-dollar trading volumes, 50x leverage in global banking, to funding technology that literally turns air into stone and biomass into underground oil to fight climate change. This deep dive has really laid out an extraordinary profile, hasn't it? A financial entity deeply embedded in global markets, using the speed and, let's face it, the sheer profitability of leverage trading, which is often criticized for being short-term focused, and using that engine to fund the incredibly slow, capital-hungry work needed for permanent climate tech.
It's a remarkable model, blending high risk with potentially very high long-term impact.
It really makes you think.
It does, and it raises a pretty fundamental question, I think. What does it actually mean for corporate responsibility when the fastest, most fluid capital out there, leverage finance, becomes a key funding source for the most static, permanent solutions needed for climate stability? For you listening, how does seeing this model, this blend of high risk, high return, high impact, how does that maybe shift your own view on the connection between profit and, well, planetary stewardship?
A vital paradox. Definitely something to chew on. That wraps up this unique deep dive. We really encourage you to think about that contrast, the sheer velocity of finance meeting the slow permanence required for environmental solutions. Thanks for joining us.